On Sunday, we had news being released that both Broadcom and TSMC are looking at deals to split up Intel Corporation, and this is something that has been discussed for quite some time. In fact, it wasn't too long ago that we had heard rumors of Qualcomm and in fact Elon Musk himself to consider buying the struggling chip company. We can note here that Broadcom has been closely examining Intel's chip design as well as their marketing business, and in fact did mention that there would be a potential bid with their advisors. However, this was only on the condition that if they could find a partner for their manufacturing division. We then separately heard that TSMC, the world's biggest contract chip maker, was separately looking at buying or controlling some of Intel's chip plants, and this was to be as part of an investor consortium or maybe a different structure. Now, talks are currently informal, and we can see both Broadcom and TSMC at this point anyway aren't looking to work together. And just today, based on this news, Intel stock is up quite significantly. We're going to show you, but it's actually up around 10%, and that is because things are starting to heat up. Whether it's TSMC or Broadcom, it does look like a very likely scenario where Intel is broken up, and we also get here another hat thrown into the ring, Qualcomm, which we just mentioned. Now, what's also interesting to note, based on this, analysts have started to increase their price target for Intel. In fact, some of them taking up near the $30 region, and they believe the probability of a separation for Intel is going to be significantly higher today than it has been over the last few months, and this is something that investors should take seriously. Now, as we can see, the shares right now are up nearly 10%, but this company has been struggling for quite some time, down 47% over the last year. Over the last 10 years, down 31%. Their 10-year high did in fact sit around the $69 mark, but that was around 4 years ago. And right now, even with this news, which does look to be good for the share price alone, the company is still trading towards the lower end of the 52-week range. All three analysts, Seeking Alpha, Wall Street, and Quant, do deem this company to be a hold. And there's also been some other factors that have played a part in this company not too long ago. We can see the CEO, now ex-CEO, Pat, in fact, was ousted by the board. He didn't have the best performance, as we just saw. The share prices have been crashing quite some time now. And then if we look at their latest guidance, we can in fact see they have issued some very weak forecasts, but overall they did form a beat in terms of what analysts were expecting. So in terms of the EPS, they came in marginally higher, 13 cents. The market wanted to see 12, and the same to be said with their revenue, 14.26 above the 13.81 that the market was expecting. Now, we also note Intel's revenues declined for a third straight quarter. In fact, it's down 7% from the same quarter last year, and they reported a net loss for the quarter of $126 million. On a year-on-year comparative, we can see that a net income was reported of $2.67 billion. So we want to understand, is now a good time to actually start considering adding this to our portfolio? What are the long-term growth prospects looking like? And in fact, what do the underlying metrics of the company tell us? We're going to start off by looking at their earnings over the last 4 quarters. They've outperformed on 2 of them, notably the most recent one, giving them a 50% track record, and based on their earnings per share estimate of 49 cents for December 2025, this company does trade right now at a forward valuation of 48.54. In terms of how that compares, well, you're probably not surprised then to see a C- on the valuation, as the sector comparative is sitting at 25, meaning right now, not only are you paying a 92% premium to the sector itself, but in comparison to their 5-year average of 28, you are paying 75% more, and that is something that will put off a lot of investors. We do note, however, depending on other valuation metrics, whichever one you look at for your own investment thesis, some of them actually show this as now as a great opportunity to buy. We can see at a massive discount if you look at the price to book, the same to be said for a price to sales, and in fact on a price to cash flow. Give us your thoughts though, maybe you do prefer other valuations or maybe a combination. In terms of the growth grade, probably no surprise again for those that have been following this company with an F rating. Year on year, negative 2%, sector at 5.2%. Forward-looking, 2%, sector at 6%, so on both comparatives it does come under, but when we look at the earnings per share anticipated growth over the next 3 to 5 years, Intel is expecting 14%, sector comparative lower at 15%, but nice to see higher than their own 5-year average of 9.4%. If we look at their profitability, they get a B+, Gross margin sitting at 34%, sector much higher at 51%, their own 5-year average also much higher at 49%. Bottom line, negative 35%, no surprises as we have seen that latest quarter a net loss. Sector comparative at 4%, whilst it is low single digit, nonetheless it's positive, and even their own 5-year average does look very strong at 15%. In terms of the cash the company generates from operations, it is significant at 8.3 billion, well above the comparative of 103 million, but just look at the last 5 years on average, this company has typically generated a much higher figure, sitting at 23 billion. Now we'll also show you the underlying metrics of the company where their free cash flow, which typically we want to see consistent growth over the longer term, hasn't been too great over the last 3 years, and we also have to point out over the next 12 months it is anticipated to continue that negative trend. In terms of sales growth, again, not looking too bright. In fact, the last 3 years have all been negative, and when we look back to the last 10, 4 of those years, they've reported negative revenue. So when we do look at their top line on a numerical format, we can see they actually reported higher sales in 2015 at 55 billion than 2024 at 53 billion. And if you do incorporate inflation, then there will be quite a significant difference between the two. Again, just things to bring to your attention. In terms of shares outstanding, they have returned excess cash to your pockets from 2015 to the latest quarter, but we need to point out that from 2021 they've actually done the opposite and they have started to dilute your position. ROIC then, 10% or more is what we typically look for. Give us faith, management are able to effectively allocate their capital. They've done very well from 2015 to 2021, but the subsequent years have been very poor, negative 2% in 2024, which does let us know they did report a net loss, which we did see earlier. In terms of operating margin, again, the same to be said, as well as the free cash flow. Up until around 2021, the numbers were very strong. Then they did fall off quite sharply, so you could look at this as a potential turnaround play. In terms of net debt to EBITDA, we want below 1.5 for semiconductors. These are the number of years it would take the company to pay off all of their debt net of cash on hand. Also correlates to balance sheet strength. 2.64, very high on a trailing 12 month, even with a nice thing to note here that over the next 12 it is expected to drop around 2, still above the 1.5 we do want to see as a maximum, but again lots of considerations as we will shortly get to our own valuation model where we will apply a margin of safety. Institutions, they hold around 65% ownership, 7 billion worth of sales over the last 12 months, but actually they have been buying a lot more in the same comparative period. In fact, in the latest quarter of Q4, they've bought more than twice as much as they have sold, so you could argue Wall Street is very bullish on Intel Corporation. In terms of inside ownership, pretty low at 0.04%. When we look at the latest quarter, no buying, no selling. In Q4, we did get some selling of around 650,000. Now, we always like to show you for full transparency who these insiders are, but do remember we don't typically take this as a bearish signal. They sell for many reasons, personal and financial, and we can see here on the 7th of November, the EVP did sell around 25,000 shares, netting them $650,000. As always though, do your own due diligence, never copy what these insiders or what these institutions do. In terms of comparing them against others in the semiconductor space of a similar size, we have Analog Devices, Micron Technology, as well as many others. Over the last year, negative 46%. They are one of the few to in fact return a negative during the period. Over the last 5 years, we see again negative performance. Bear in mind, they did used to be a dividend paying company, and this is total return, so it includes reinvesting those dividends. The worst over the last 5 years and the only one with a negative performance. And then we get to over the last 10 years, with even reinvesting those dividends, they are still a negative 5%. Not great at all, but as always, past performance isn't an indicator of the future. And whilst the answer is now very obvious, we do want to show you in a graphical format the S&P has outperformed Intel over the last year, the same conclusion over the last 5, and the same conclusion over the last 10. Remember, we're highlighting this, very important to understand, because when you are picking individual stocks, you're picking them because you believe they can outperform whatever your investment horizon is over the next 5, 10, 15, 20 years. Then we want to show you the income statement because yes, their revenue very inconsistent over the last 10 years, but we want to understand what does their bottom line do, what is the direction it take, is there a similar story to be told, and we can actually see very, very inconsistent, and ultimately highlighting in 2024 they did report a loss, negative 19 billion. Definitely considerations that need to be had by both investors who are current as well as those who are potentially looking to add. Then we get to the balance sheet, a quick health check, total cash versus total debt, where their cash very inconsistent over the period, slight decline from 25 billion in 2015, now sitting at 22. And remember, we always compare this to their total debt numerically and directionally, because one number here in pure isolation isn't going to tell us anything, and their total debt has actually more than doubled over the period, going from 23 billion in 2015 to now sitting at 51, and has only been increasing year on year. Definitely things that we need to understand. Doesn't mean we shouldn't invest, but definitely things we need to be made aware of. And then finally, we just want to highlight the cash this company does generate from operations, which has really only been decreasing from around 2020, although 10 years ago 19 billion, right now sitting at pretty much half of that at 8.3. And remember, it wasn't too long ago where Intel finalized around an 8 billion grant under the CHIPS Act, and something we did expect to really help this company, especially with Donald Trump now as president, who is looking to bring a lot of manufacturing right into the US. But it remains to be seen how this actually will affect the company if they were to be split up. Now, just before we jump into our valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 32 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then get into our intrinsic value, where we get to $27 derived from the DCF model. Now we'll explain how we got that. We do have the free cash flow year on year. We then have the average growth, although skewed given the fact it is negative, and then we get our three different growth rates, low, medium and high. As always, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Intel or any others. But based on the low rate, we want to be very conservative today of 0%, and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see here, $27 indicating 8% upside. But as always, to be transparent, we will show you at the other rates, 4%, $36, 46% upside, and for those that believe they can achieve the 8%, $48, indicating 94%. That is nearly a double from the current value. Now, we want to be very conservative today, given the fact they have had poor performances on quite a consecutive basis, but as always, these numbers are subjective. Given the 0% growth rate at the $27 mark, when we do apply a 10% margin of safety, it isn't too far off, so you could argue near the current trading price today, you're getting a 10% MOS, and Wall Street, as we saw, it was a triple hold rating earlier on. They see this at $26 over the next year, indicating only 4% upside. Now, for example, for those that believe it should be a little bit higher, so we will take the 4%, we can show you the exact same scenario with the margin of safety. At a 10% point, it would be a buy at $33, and then as we keep going based on these estimations, you can see right now, if you believe they can grow their free cash flows at the 4% rate, you're looking at a 30% MOS right now, but again, that doesn't change Wall Street and their beliefs. They only see 4% upside over the next year. As always though, do give us your thoughts in the comments below. Is Intel a buy, hold or sell, and whether or not this news release affects you as a shareholder or maybe a potential one. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon below where we do cover our weekly buys and sells, and we have been making some given the volatility over the last few weeks. As always though, have a great day and we'll see you all on the next one.